All right, let's get started. Well, once again, thank you everyone for joining us for our Kickoff to Financial Freedom series. On behalf of the Detroit Regional Chamber, the Detroit Promise, and the Alumni Association, I want to thank you for joining us today for our third webinar for our series. I'm Shantae Kane, campus coach for Macomb Community College and Alumni Success Coordinator. So some of you know me, some of you don't, but I hope to get to know all of you in the near future. We here at the DRC have listened to topics that are of interest to you and what you want to learn more about. And so we're so grateful to have leaders and consulting and banking provide webinars for our financial literacy series. So today's presentation is managing student loans. Please feel free to submit questions to our chat as we will ask them to our guests at the end of the presentation. So just like you did the thumbs up, go ahead and submit those questions as you listen to the presentation in the chat. So we will get to those at the end and definitely get you some answers. So stick around for some important information afterwards, after the question and answer session as well. So today our speaker is from Citizens, and Citizens has branches located in Detroit throughout southeastern Michigan, and they are ready-made to provide solutions and expertise in the field for their clients and ready to make a difference and change in our communities, from working with the homeless to helping people work on their own progression in the professional realm. So we are so proud to have today's presenter representing Citizens, Michael Jones, Vice President of Student Lending and our Relationship Manager. Michael, thank you so much for joining us today.
Thank you. Thanks so much for having me. And I can take control to share my screen. All right. Okay, can you see that okay?
Yes.
Yep, I can see you.
All right, there we go. Well, first, thank you so much for having me. And thank you all for joining this session on managing student loan debt. Student loans have definitely been a really hot topic here over the past several months and over the past year or so. And so hopefully this session will provide you with some insight as well as information to help you with managing your student loan debt. So it's important to understand the details of student loan repayment, because those details can help provide you with information on how to plan out repayment, how to come up with a plan, as well as how to find options that will help you manage repayment. And I'm gonna stop one moment here, because like there's a couple of people waiting in the waiting room. Am I able to let them in, or?
Everyone should be in, Michael. I don't see anyone in the waiting room now, so you should be good to start. But if anyone else pops up, I'll be sure to let them in.
Okay, perfect. I wasn't sure if you were able to do that or not. So again, this session will really provide you with an overview of understanding repayment, how to come up with a plan, and how to find the options that are available to help you manage repayment. And my screen does not want to advance here. One moment. Okay. So one of the very first steps that you should do is locate all of your student loan information. The easiest way to find federal loan details and the amount that you owe is to log on to the studentaid.gov website. Here, the Department of Education, they keep record of all the different federal loans, as well as any kind of federal grant Pell Grant money that you may have received. Now, if you take out private student loans, really the best advice is for you to keep records of the lenders that you borrowed from. However, if you are unsure who you have borrowed from, or maybe if you just kind of misplaced those records, you can reach out to the financial aid office of the school that you attended, and they can assist you with finding out who your lender was for private loans. Or you can even pull a copy of your credit report by going to annualcreditreport.com, and that report will have information on who your private loan lender is, as well as their contact information. Now, to start, we are going to take a dive into federal loans. Now, it's important to remember that there are a number of different types of federal student loans that you may have borrowed under. There's the direct subsidized and unsubsidized loans. Now, these loans are capped at a certain dollar amount, depending on what year you were in school when you applied and when you borrowed. Now, the difference between these two different loans is with the subsidized loan, the interest is paid for by the federal government while you're in school. Now, with the unsubsidized loan, you are responsible for the interest while you're in school, but we'll go a little bit more into that a little bit later on in the presentation. Now, the Parent Plus loan, as you would expect, that's a loan that the parent would have taken out for a dependent student. The Grad Plus loan is a loan for grad students. And then the Perkins program was actually phased out back in 2017, but there may be some of you who borrowed under that program. And just in case if you did, you actually would want to contact the school that you attended, the financial aid office at the school that you attended, and they can provide information to you on how to begin repayment and who you need to send payment to. And then there's the consolidation program. And we will go into consolidation a little bit later on in the presentation. So who do you repay? Federal loans are serviced by a number of different companies who have contracts with the federal government. Now, the servicer of a federal loan is the agency that receives the payment from borrowers, and they handle all aspects of repayment on behalf of the federal government, who is the actual lender. Now, this slide shows all the current federal loan servicers that the government currently have contracts with. Now, the loan servicer will work with borrowers on repayment options and any other tasks related to federal loans. Now, you are actually assigned a loan servicer by the federal government after your loan is first dispersed. And you can find out who your servicer is by visiting the studentaid.gov website. Now, for private loans, you should really work with the lender, contact the lender that you borrowed from in order to determine the different repayment options that's available with that private loan lender. Now, interest. One very big piece of a loan is the interest. Interest is the amount that a lender will charge periodically for the privilege of using their money. And the amount is usually quoted as an annual rate. Now, for federal loans, they all have a fixed rate, which means that that rate is locked in from the time that that loan is taken out until that loan is fully repaid. Now, with private loans, they may have a fixed rate or a variable rate. Now, with variable rates, they are subject to change throughout the life of that loan. And what will cause that rate to change is tied to different economic factors. And so whether or not if that rate goes up or down is tied to the economy. And if that rate goes up or down on variable rate loans, your monthly payment also can fluctuate and go up or down. Now, interest capitalization. Now, this is a term that you may not have heard of, but certainly you should become really familiar with. So basically, when you borrow money from someone, the interest is what you pay them for using their money. And when you were in school, or maybe if you are currently in school, and if you're unable to make any payments while you are in school, that interest just adds up. And so once you leave school, the interest that has been adding up, it now becomes part of the amount that you need to pay back. So it is added to the principal loan balance. So the amount that which is the amount that you originally borrowed. And once that amount is added onto the original amount that you borrowed, that is called capitalization. And from that day forward, you will pay interest on that new total amount of that, which was the original loan amount plus the capitalized interest until that loan is paid off. Now, if you pay off the interest that is adding up while you are in school, there is no interest to capitalize, which is really a great way to keep from paying interest on top of interest, and it also will reduce the overall cost of that loan. So if we take a look at this chart here, and if we take a look at the original loan amount, the very first one for $15,000, you can see that the interest rate on that $15,000 loan was 5.05%. And so with this particular borrower, they decided to postpone payment. So they decided not to pay anything at all while they were in school. And they also didn't pay anything during that 6-month grace period that borrowers have once they leave school or graduate. So during that time frame, from the time that loan was taken out, and during the 4 years that this student was in school, and the 6-month grace period, the total amount of interest that had accrued was $3,408.75. Once repayment started, that total amount of $3,408.75 was then added onto that original loan amount. And so now the amount that borrower has to pay back is $18,408.75. So this chart is really used to kind of illustrate how quickly the interest can add up if you're not paying interest at all while in school. Now, right now, under the Federal CARES Act, and we'll talk a little bit more about the CARES Act a little bit later on in the presentation, but right now, under the CARES Act, the federal government have paused payment on any federal student loans. So right now, there's no payment required, and they have also set the interest rate to 0% on all federal loans. So right now, there's no interest accruing if you have any kind of federal loans out. The rate is at 0%. So if you are in the position to make payment, any kind of payment, even though it's on a federal pause, but if you're in the position to make any kind of payment towards your federal loans, I strongly recommend that you do so, because any payment that you make, it goes strictly towards the principal loan amount that you borrowed. And that's really the quickest way to pay down the any kind of student loan debt, is making payment towards that principal loan balance. Okay. So next, we are going to move into the different type of repayment plans that are offered through the federal government. Now, it's important to note that the Department of Education does offer a loan simulator tool for you to utilize and get estimates of how much you would pay monthly, as well as how much you would pay overall for that particular repayment plan that you may be under. Now, this tool is located on the studentaid.gov website as well. Now, these plans can be quite similar, and also they can be a little overwhelming for you to look at and to compare. So really the best advice is for you to work with your loan servicer on deciding, which plan is right for you. So let's take a look at some of the 3 basic federal loan repayment plans that are offered. So the first one here is the standard repayment. Now, under this particular plan, pretty much most borrowers are assigned this plan right out the gate. But you do have the ability to change plans at any time and for no cost at all. But under the standard repayment plan, you will actually pay less over time under this plan than any of the other plans that I'm going to present to you. Also under this payment plan, the payment amount is at a fixed amount that will ensure that that loan is paid off within 10 years. Now, if you decide to consolidate, and again, we'll talk more about that a little bit later on, but if you decide to consolidate, you actually will have up to 30 years under the standard repayment plan. And the minimum payment amount is $50 per month. The next plan here is called the graduated repayment plan. Under this plan, your payment starts off lower at first, and then it gradually increases, typically every 2 years. And the payment is set to ensure that the loan is still paid off within that 10 to 30-year time frame. It's consolidated. However, you will pay more over time under this plan than you would under the standard plan. The graduated plan is actually could be a good option for those borrowers who maybe income start off lower at first, but you expect your income to increase steadily over time. In that kind of a situation, graduated might be a good option for you to consider. And then there's the extended repayment. Under this plan, payments are lower at first, and then they do gradually increase. With the extended payment plan, there is a minimum of $30,000 that the borrower must have in federal student loan debt. Under the first 2 plans, there is no minimum loan amount that you must have. Now, under the extended payment plan, borrowers do have up to 25 years to repay back that loan. The monthly payment will be lower than the standard as well as the graduated repayment plan, but you will pay more over time with the extended plan with the plan going up to 25 years. And the extended also has a minimum $50 per month minimum payment. Now, this next set of repayment plans are known as income-driven plans. These plans set your monthly student loan repayment at an amount that is intended to be affordable based on your income as well as based on your family size. Now, again, you should contact your loan servicer for free help on determining which plan is the right plan for you, as well as to apply for any of these payment plans. Now, with the income-driven plans, there are 4 of them. They are the income-driven repayment or revised pay-as-you-earn, pay-as-you-earn, income-based repayment plan, as well as income contingent repayment. Now, under these plans, payment is set at a percentage of your discretionary income, which is the amount of income that is left over after paying for like taxes and personal necessities like such as food and shelter and clothing and things like that. Now, the payments are recalculated annually and are based on your income and your family size. So each year, borrowers have to reestablish their eligibility under these income-driven repayment plans. Now, depending on your income and your family size, you may actually have no monthly payment at all to make. So your monthly payment could actually be at zero. Now, with that being said, if you pay $0 a month, the interest is still accruing under these plans. Now, under all four of these plans, any remaining balance is forgiven if your federal student loans aren't fully repaid at the end of the repayment period. Now, whether you will have a balance left to be forgiven at the end of your repayment period, it depends on a number of factors, such as how quickly your income rises and how large your income is relative to your debt. Now, because of these factors, you may fully repay your loan before the end of your repayment period. Now, your loan servicer will track your qualifying monthly payments and the number of years that you've been in repayment, and they will notify you when you are getting close to that point where you may qualify for forgiveness of any remaining loan balance that you may have. Okay, so now we are going to take a look at private student loan repayment options. Every lender may differ in the different repayment options that they may offer, but there are three main types of repayment options that you will see with most private lenders. The first one is immediate repayment, which is exactly like it sounds. This is where you would go into immediate repayment for both principal and interest while the student is still in school. The other option is interest-only payment. This is where you can make payment towards just the interest alone while in school. Now, some lenders may also offer or have a requirement where you pay just $50 per month towards the interest. Again, I always strongly encourage students and families to take this payment option if you can. It really is the best way to avoid that capitalization of interest that we talked about earlier. Also, so not only does it allow you to, keep that interest from accumulating and having that large balance capitalized onto the original loan amount, but many lenders will also offer you a lower interest rate by making some type of payment while in school. So again, if you're able to just pay the interest while in school, I just strongly recommend and encourage you to do that. And then the last option here is deferred. Deferred repayment is when payment towards principal and interest is deferred until after graduation, or maybe before or after dropping below half-time enrollment status. Now, again, it's important to remember that the interest does still accrue on any loan that's in that deferred status. There are also different repayment features that some private loans may offer as well. features such as a 6-month grace period from the time you leave school or drop below half time. So with most lenders, once you leave school, they will offer that 6-month time frame before repayment actually is required. Some lenders may also offer a feature called cosign release. This is a feature where the borrower, the student borrower, can apply to have their cosigner removed from that loan obligation after making so many on-time payments towards that private loan. And then most private lenders also offer other types of deferment and forbearance options for different situations. So for example, maybe, unemployment, and you're just unable to make payment on your private loan. Most lenders will offer an option that will allow you to temporarily postpone payment during that time frame. Or there could be an internship or a residency that you may be participating in. Many private lenders will also allow you to postpone payment in those kind of cases or situations. There also could be a postponement due to economic hardship. But again, keep in mind that anytime you postpone or defer payment, whenever you do that, the interest will begin to accrue. And then you will have that situation where the interest is capitalized and again added onto that original loan amount. So even during those kind of situations, and those things happen, right? We have, situations or have, maybe different economic hardships that may put us in a position where we're not able to make our payment. But even when those situations happen, even if you're able to just pay the interest, rather than doing a full deferment and not paying anything, even if you're able to just pay the interest and keep that interest from adding up, you will really be better off in a much better situation overall if you're able to do that. So again, just keep that in mind. So we just went over a lot of information that can be incredibly complex. But this is just a quick summary of what we've discussed. So first, I just want to point out to you again about the loan simulator tool located at the studentaid.gov website. This is a really great resource. But again, I strongly encourage you to work directly with your loan servicer for both your private loans as well as with your federal loans. Now, it's certainly understandable, right, that you can sometimes be enticed by the lower monthly payment or by not making any payment at all. But it's important to understand the cost of borrowing money and how much more you will pay over the life of a loan by choosing the lower monthly payment. So just keep that in mind. By not paying or paying the lower amount, how that can impact you later on. It's also really great to have so many options, right? We talked about all the different federal loan options and repayment options that's available. But again, I always say, the more that you pay now, the less that you will pay overall. And you can always even pay extra without any kind of penalty or anything like that. And then lastly, remember that, the choices you make on your loan options and repayment, how that will impact how much in total that you will end up paying. So just always, keep that in mind when you're making, when you're selecting the different options that's available to you. All right. Now we are going to look at refinancing and consolidation. Now, both of these options allow for multiple loans to be combined into one payment. But with private refinancing, it allows for both private loans as well as federal loans to be combined. While just federal consolidation, it only allows you to consolidate your federal loans. So you cannot take a private loan and put that into the federal consolidation program. All right. Now, with refinancing, refinancing student loans, it can potentially allow you to lower the interest rate depending upon credit and the current rates in the market. Now, right now we are in a more rising rate environment currently. So, this may not be a good time to refinance. However, if your current rate is higher than what rates are right now, then you may still want to consider refinancing. This option could be a benefit if you have, maybe multiple loans that you would like to combine into one payment, or possibly lower the total amount that you pay by reducing your interest rate, either because maybe now you have better credit than you did when you took out that private loan, or because rates are at a lower, are much lower now than what they were when you originally borrowed. Now, refinancing into a private loan, it allows for the choice of doing a fixed rate or a variable rate, as well as different repayment terms. And there is the potential to lower your monthly payment amount as well. So let's say if you have out a private loan and your repayment term is at a 10-year term, but at that 10-year term, the monthly payment is just too much. I mean, it's just really hard to afford that monthly payment at that 10-year term. Refinancing and extending that term out to a 15-year term to get a lower payment might be something that you may want to do, because now that payment is more affordable to you. Now, you're going to pay more because you're extending that loan out over a longer period of time, but it is a way to get your payment at a lower payment amount if that's what your goal is, if that's what you're trying to accomplish. Now, credit worthiness is taken into consideration when applying for a private refinance loan. And there are multiple borrower benefits that you may qualify as well that will vary from lender to lender. So you will want to consider things like your credit score, as well as consider even the stability of the lender that you are looking to possibly refinance your loans with. Under federal consolidation, under this program, it's an option that will allow you to combine multiple federal loans together into one new loan with a new interest rate, and it allows you to pay over a longer period of time. So with consolidation, you can spread your payment out up to 30 years. Now, federal consolidation, it may be a benefit if you have multiple loans with different interest rates. And maybe if you want to combine them into just one loan with one fixed rate. Now, with federal consolidation, what they will do is they will take the weighted average of all the federal loans that you're looking to consolidate, and they will round that up to the nearest 1/8 of 1%. And that's how they get the new rate for any federal loans that you may be looking to consolidate. Now, it's important to note that you will pay more interest over the life of that loan if the repayment term or if the repayment period is extended over a longer period of time. So keep that in mind. You also want to pay attention to any benefits on the original loan that you may be forfeiting by refinancing or by consolidating. So for example, let's say if you were doing one of the income-driven repayment plans that we talked about earlier with your federal loans, and you have a chance for some loan forgiveness. You're getting to the point where you may qualify for loan forgiveness at the end and get some of your loans forgiven. Well, in that kind of a situation, you may not want to refinance because you will now be forfeiting that benefit of getting your federal loans or a portion of your federal loans forgiven under that income-driven repayment plan. So just keep that in mind if you are considering private refinancing as an option. Okay, now we are going to talk about a few types of loan forgiveness and discharge. This is when a borrower is released from paying either all or a portion of their loan obligation. So for direct loans, some examples might include things like teacher loan forgiveness program, which is a program that was created to attract teachers to teach in low-income schools. For those who qualify, they may be eligible for forgiveness up to $17,500 on their direct subsidized and unsubsidized loans. There could also be like a school-related discharge, which the most common type would be like the school closing. So you're attending the school, you've taken out loans, and they close down. You can get a portion or maybe all of your loans discharged in that kind of a situation. Now, public service loan forgiveness, we will talk a little bit more about in the next couple of slides. There could be bankruptcy. Generally, when it comes to bankruptcy and student loans, it will only occur in the most extreme of situations. So it can be really challenging and really difficult to get student loans discharged due to bankruptcy. And then there could be cases of permanent disability or due to death. In those kind of situations, federal loans are fully forgiven and discharged. When it comes to private loans, some lenders do forgive loans in the cases, again, of permanent disability or due to death of the borrower. Okay. Student federal debt relief cancellation. I want to talk a little bit about that. So first, we will talk about what the cancellation plan is, and then we will discuss where the plan is at currently due to different legal challenges over the last few months. So what is debt cancellation? On August 24th of 2022 of last year, President Biden announced loan cancellation for some borrowers. And so loan forgiveness will apply to both current students and borrowers who have federal undergraduate loans, graduate loans, as well as Parent Plus loans that was first dispersed by June 30th of 2022. So it includes undergrad loans, grad loans, as well as Parent Plus, but the loans had to be dispersed prior to June 30th of 2022. Now, the plan will cancel up to $10,000 in federal loans for borrowers who make less than $125,000 or for households earning less than $250,000 would be eligible to receive up to $10,000 in federal loan cancellation. Now, for borrowers who received a federal Pell Grant and they meet the income requirements that we discussed, they will be eligible to receive up to $20,000 in cancellation of federal loans. Now, the application for debt cancellation, it went live on October 17th of last year. The application went live. However, the application was paused. So they shut down the application system on November 14th of last year due to the legal challenges. And so as of right now, debt cancellation is just tied up in the courts. I believe the Supreme Court is supposed to hear this case sometime this month, I believe. But right now, it's been placed on hold. So more to come on debt cancellation. Public service loan forgiveness. So I want to talk a little bit about this. So public service loan forgiveness. This is a great program that was created for a reason. And the reason was to get people into certain public service jobs. Now, this program, it forgives the remaining balance on direct loans after you have made 120 qualifying monthly payments under a qualifying repayment plan while working full-time for a qualifying employer. So what does all of that mean? A qualifying payment has quite a few criteria in its definition, including you must be signed up under a qualifying repayment plan. So we talked about all the different repayment plans that are available. You must be signed you have to be signed up in a qualifying repayment plan. Your payment also must not be late must not be more than 15 days late from the original due date, and the payment must take place while you are employed full-time by a qualifying employer. Now, the 120 payments do not need to be consecutive on-time payments. So, for example, if you have a period of employment with a non-qualifying employer, you will not lose out on credit for prior qualifying payments that were made. And as far as the on-time payments, really the best way to make sure that you are making on-time payments is to work with your loan servicer and to make sure that you set up automatic pay deduction. That will just ensure that your payment arrives on time. Now, as far as the qualifying employment for the Public Service Loan Forgiveness Program, it's not about the specific job that you do for your employer. Instead, it's more about who your employer is for the Public Service Loan Forgiveness Program. So qualifying employer include any government organization at any level. So it can be at the federal level, it can be state, local, or tribal level. The organization must be a not-for-profit organization that have a tax exempt under Section 501c3, or serving as a full-time AmeriCorps or Peace Corps volunteer also count as a qualifying employment for the purposes of the Public Service Loan Forgiveness Program. Now, there's a plethora of information on Public Service Loan Forgiveness on the studentaid.gov website. including a help tool that can help assist and provide additional information about the program and what you need to do to participate in that program and possibly have a portion of your loans forgiven. Okay. As I mentioned earlier, the federal loans have been suspended as far as payment, have been suspended. And the federal government have stopped collections on defaulted federal loans, and they have set the interest rate at 0% through the CARES Act. Now, as of today, the federal pause on federal student loan repayment has been extended through June 30th of 2023. Now, again, you're going to probably get tired of hearing me say this, but you know, if you're able to, you know, I just strongly encourage borrowers to continue to make payment, even if it's just towards the interest, if you're able to do so, because it will just reduce the overall principal of that loan when the pause period expires, and eventually it will expire. I mean, the federal pause started in March of 2020, I believe, and so it's been extended several times. Eventually it will expire, and borrowers will go back into repayment. So the more you can pay now, and the more you can begin to chop down on that principal loan balance, the better off you would be once repayment resumes. Okay, scams. So, you know, it's critical to also help students avoid scams, because there's a lot of them out there. There are a lot of companies that would like to benefit from students and families who are just unfamiliar with the repayment process. And so these are just a few headlines that have been in the news recently. Now, there are 3 ways to spot a student debt scam, which include, you know, if you are asked to pay upfront costs, or if you are asked to pay a monthly fee, it's probably a scam. If you are promised immediate loan forgiveness, you know, it goes back to that old saying, you know, if it sounds too good to be true, it probably is. It's probably a scam if you're offered immediate loan forgiveness. If you are asked to provide your FSA ID number, or if you are asked to provide your PIN number, it's probably a scam. So just be mindful and just be aware of any kind of suspicious email that you may receive. And whenever you are in doubt, you should always contact your servicer directly to find out if it's information that they're sending to you or if it's a scam. So always reach out to them directly if there's any kind of doubt at all. Where to get help? You know, there may be times when you are in a situation where you feel that, you know, the information that you are being provided with is maybe incorrect, or maybe you've been treated unfairly in the student aid process. If that's the case, there are a few places that you can go to if you need help beyond the help that what you can get from your school or what you can get from your loan servicer. Studentaid.gov, where the feedback system and the ombudsman can be accessed, and the Consumer Financial Protection Bureau are 2 resources to provide borrower feedback. Borrowers can also report any kind of suspicious email or unfair and deceptive activity or practices regarding the student loan repayment process. Now, I hope that you never have to access any of these services, but just know that you do have resources available to you if you are in that kind of a situation. Okay. Finally, here's just a list, just kind of summarizing the steps that you can take prior to going into repayment, or maybe if you are already out of school, you're already in repayment, just some things that you should be aware of and some steps that you can take as well. And so the first thing is to get to know your loans. Go out to the studentaid.gov website. See what loans you have. Know what type of loan it is. Is it a subsidized loan? Is it an unsubsidized loan? What's the amount? What's the interest rate? What rate are you paying? So that way, if you are looking to do some type of refinance or consolidation, you know what your rate is right now, and you have something to compare to if you're shopping around to see if you can get a lower rate. So get to know your loan. Find out, can you consolidate? Should you consolidate? Should you refinance? Is that a good option for you? Keep in mind that if you decide to refinance or if you decide to consolidate, you will lose any kind of benefits that you may have been entitled to, especially when we're looking at the federal loan program. The federal government, they do offer a lot of protections under the federal loan program. If you decide to refinance your federal loans with a private lender, you're forfeiting all of those protections and all of those benefits offered through the federal government. So that may not be the thing for you. So just be mindful of that, and be mindful of the fact that once you refinance, you're forfeiting those options and those benefits that's available. Figure out how much your monthly payment will be, even if you're not in repayment yet, but you know you've taken out loans. Figure out what your monthly payment will be, so that way you can kind of begin to budget for that and kind of prepare for that once repayment does start up. Make your payments automated. Number one, it ensures that your payment won't be late, right? As long as you have the money in the account, it ensures your loan payment will not be late. But also, many lenders will offer a rate reduction if you sign up to automate payment. So consider automating your payment. Determine if you qualify for loan forgiveness. Talk with your loan servicer. Find out if there's a plan that you qualify for that can lead up to loan forgiveness for you. And pay more if you can. Again, it can be hard to pick that higher payment option, or it can be hard to pay more money than you have to pay. But trust me, it will benefit you in the long haul if you're able to pay more towards your monthly, towards your student loan debt. And then lastly, ask about employer assistance loan repayment programs. Now, this is something that's kind of fairly new within HR, but there are more and more companies out there that are beginning to offer some type of loan repayment program to their employees. So some companies are maybe they might match, like do a dollar for dollar match towards your monthly loan payment, or they may just do a lump sum, percentage towards payment towards your overall loan balance. But look into it. Many employers are beginning to offer things like this as a part of their employee benefits package. So ask your employer or your potential employer if they offer any type of student loan repayment program to their employees. And with that, that takes us to the end of this session on managing student loan debt. So I am going to turn it back over to Shantae.
Thank you so much, Michael, for joining us, and thank you for taking your time to explain to us all about student loans. So we have a couple of questions that I'll go over. One thing to note is that students, you will find your student loan offers and any student loans that are available to you in your financial aid section. When you apply for financial aid, you will see what is being offered to you in those sections at your respective schools. Email accounts. So it might be my Macomb in my case. So that's where you'll find your award letters and those loans that are offered to you. So one of the questions is what happens if I don't acknowledge my student loans and do nothing?
Yeah, really, really good question. So, once your loan, if you decide not to do anything, and as a result of that inaction, your federal loan's going to default. What happens? What's the consequences? Well, there's a lot. There's a lot of consequences if that should happen. One is you will have a damaged credit report for the next 7 years, and you may think that's no big deal right now, but if you're in a position where you're trying to secure credit and there's a defaulted student loan that shows up on your credit report, and again that stays on there for 7 years, it can have a real impact on you. Number two, the federal government, they have a long reach, right? They have ways of getting their money. So one thing that they can do is they can actually seize your tax return refund. So you go to file a tax return and you're expecting a refund back from your taxes. The government can easily seize that. They do that all the time. I have so many different stories where students defaulted on their loan, didn't think anything about it, and years later, they file their tax return and it's garnished. So they can do that. The other thing that they can do is they can also garnish your wages. Now, years ago, the government had to go through a huge process to garnish someone's wages. Like they had to go through a huge court process to garnish a defaulted borrower wages. That's no longer the case. There's no longer a court process they have to go through. Once a borrower has defaulted on their student loan, the federal government can immediately garnish their wages. It can be a portion of their wages. It could be all of their wages. But again, they have a long reach, and they do have ways to get their money when it comes to that.
Oh, thank you. I was muted there for a second. And our final question for today is, why does the government need my parents' information? Will they get in trouble if I don't pay?
Why do they need your parents? So I think what the question is asking is, this person's asking, like, when I filed my FAFSA application, why did the government, want my parent to provide their information on there as well? I think that's what the question is maybe kind of referring to.
Yes.
Yeah, and so the reason why is, according to the federal government, and in their eyes, and the way they see things, is that a person, a student, is considered to be dependent of their parents up until they reach the age of 24, I think it is, or up until they are married, or if they're a veteran of the U.S. services, or if they have dependents of their own that they provide more than half of their support towards. And I think those are like the main ones. There may be a couple other questions that they will ask to determine if you're dependent or independent. But according to the government and from their standpoint, they just feel as though a person is considered dependent of their parents up until you meet these certain requirements. And if you haven't met those requirements, they consider you to be dependent, and they will require that your parents provide their information on your FAFSA application as well. Now, there are some situations that may occur where a student may not meet the government's definition, right, of being a independent student. But maybe that person really is like independent. Maybe there's no parent involvement. This person is on their own. They're making their own living. They're not receiving the kind of support or offer from their parents. There could be, extenuating circumstances that may be at play. And in those situations, the financial aid department at the school, they have the ability to kind of override your dependency status, but it has to be extenuating circumstances. When I say extenuating, I mean like cases of maybe abuse or neglect, things like that's normally easily to document. Maybe there's something that has gone through the court system. So under like extenuating circumstances, a person that may not meet the government's definition of being independent may still be able to have their dependency status overridden if certain conditions are met.
Thank you so much, Michael. So once again, if you have additional questions, please feel free to reach out to Michael via his email address on the screen. Could you read that out to us one more time? Your email address?
Oh, yes. It's michael.a.jones@citizensbank.com.
Thank you. And if you have any additional questions for me as the coordinator, feel free to reach out to me. Many of you have my information. It's skane@detroitchamber.com.